ETFs, specifically bond ETFs. Now, I want to start by giving you 5 important points you need to know about bond market ETFs. Number one, they trade very much like stock ETFs. They are traded on major exchanges, not OTC, over the counter, like a regular bond market, dealer to dealer to broker. So they trade like stocks. Number two, the bond ETF market is smaller than the stock ETF market, but it is growing and it is growing aggressively. Number three, bond ETFs invest only in bonds. Now, different credit qualities, different maturities, but it doesn't mingle with stocks or commodities or foreign exchange. They're specifically bond ETFs. Now, the fourth thing you need to know about bond ETFs, they do not mature. Unlike a regular bond where you get your principal back at maturity, bond ETF doesn't mature. So it's a little bit more risk than a regular bond, but at the same time, more risk, more reward. And then the last thing to consider is you may wonder, what's the difference between a bond ETF and a bond mutual fund? Well, it comes down to active versus passive management. Bond ETFs are passively managed and much more transparent with, of course, lower fees than traditional bond mutual funds. So that gives you kind of an overview of the bond ETF world, which is growing. And as always, I want to talk to you about a pattern, an Elliott wave pattern that happens across all asset classes, including the bond ETF space.
So let's begin by looking at BND, which is the Vanguard Total Bond ETF. This invests in U.S. investment grade bonds, and the purpose of which is to keep pace with U.S. bond market returns. So this is the BND ETF on a daily bar chart, which looks similar to pretty much any other bar chart you'd find in any other asset class. Now, if we dig just a little bit deeper and you look at it, you may start to see jump off the page at you this contracting triangle here. Perhaps you'll see a larger contracting triangle of one higher degree and even a diagonal triangle going into this high in 2019. So as an Elliottician, your interest may be piqued. If you go one step further in your technical tool case, you might look at the momentum indicators. And one of the things you see here, first of all, is this large triangle in price is mimicked by the triangle in momentum. This is a common occurrence in a contracting triangle. And finally, this diagonal into the peak was also with a peak in momentum. So momentum is not diverging, it is higher than it was here, just like price was higher. So you put that together as an Elliottician, and the pattern emerges that this looks like it was a small degree fourth wave up into a wave 3 high, which fits with this peak in momentum. Looks like a contracting triangle, which we would now say is a fourth wave based on this 3 up here, which also fits with momentum here. So what you would look for is a break in momentum confirmed by a break in price. Now, wave E only went to 50% retracement. When we wrote this in real time, we thought it might dip a little bit closer to 62, but it had done the minimum. And of course, as you might be able to anticipate, this is what unfolded afterwards. So here was your 3, 4, 5 for wave 3. You indeed had the momentum break here, and you had what has unfolded as a fifth wave thrust to a new high, which actually has achieved the minimum measured move. So here's an example of how you have a bond ETF with a clean Elliott wave pattern, wave 3 peak, no momentum divergence, contracting triangle, wave 4, leading to a thrust, perhaps a terminal thrust in wave 5, and momentum is diverging, also a fifth wave signature. So a bond ETF, similar to all other ETFs, show the same Elliott wave pattern over and over again.
So there you have it, an Elliott wave pattern where there's a triangle of different degrees. Not only can you anticipate how the triangle is going to unfold, you can also anticipate how it's going to end up once it is complete. So whether it's bond ETF space or whether it's fixed income generally or stocks or commodities, the same Elliott wave pattern often leads to very strong opportunities that you can and perhaps should use to help manage your risk reward and your percentages and probabilities.